All right, so we've got a real head scratcher for you today.
Yeah.
Imagine a company like UPS, a name everyone knows,
Mm.
down a staggering 50% from its peak.
Wow.
Now picture this. It's also offering a 5.9% dividend yield
Okay.
right in front of investors.
Yeah.
Is this a once-in-a-lifetime opportunity or a trap
Ooh,
waiting
yeah.
to be sprung? We're diving into analysis from the Motley Fool to try and figure this out.
Yeah, it's a fascinating situation for sure.
Okay.
And it really reminds me of a detective story.
Oh.
We need to look beyond the surface, examine the evidence, and see if we can predict UPS's next move.
So let's start with the scene of the crime then.
Yep.
UPS's recent performance hasn't been pretty.
No.
Revenue growth is flatlining, margins are shrinking, and the stock chart looks like a downhill slalom course.
Yeah.
What exactly is going on here?
Well, the Motley Fool highlights a crucial factor.
Okay.
UPS is deliberately cutting ties with its biggest customer,
Huh.
Amazon, by a whopping 50% over the next few years.
Boy, that sounds crazy.
I know, right?
Why would they ditch their biggest client when they're already struggling?
That's the million-dollar question.
Okay.
The Motley Fool's take is that UPS is playing a long game.
Okay.
They're betting that shifting away from low-margin behemoths like Amazon and focusing on smaller, more profitable clients will ultimately lead to higher returns.
So it's like they're trading short-term pain for potential long-term gain.
Exactly. Think of it as pruning a tree.
Okay.
You might sacrifice some branches in the short term, but it allows the remaining branches to grow stronger and produce more fruit in the long run.
Okay, I'm starting to see their logic.
Okay.
But how are they planning to make up for the lost revenue from Amazon?
They're doubling down on two key areas:
Oh, okay.
small and medium businesses,
Mm-hmm.
or SMBs for short, and healthcare logistics.
Let's unpack those.
Okay.
First, the SMBs.
Right.
How are they tapping into that market?
Through their Digital Access Program, DAP for short.
Okay.
This program provides SMBs with tools and services to manage their shipping and logistics more efficiently.
I see.
It's been a huge success, generating billions in revenue already.
So they're essentially becoming the go-to shipping partner for smaller businesses.
Exactly. And the beauty of this strategy is that SMBs
Yeah.
tend to be less price sensitive than giants like Amazon, which means higher margins for UPS.
Okay, that makes sense.
That's good.
Now let's talk about healthcare logistics.
All right.
Why are they so bullish on this sector?
The global healthcare logistics market is booming, and UPS is betting it will double in revenue by 2026.
Wow.
They're making strategic acquisitions and investments, like buying a European company, specializing in cold chain shipments for temperature-sensitive medications.
So they're not just dipping their toes in the water, they're diving headfirst into healthcare.
They are. They're building specialized facilities and expanding their network to handle the unique demands of healthcare logistics.
All right, so we see that UPS is facing challenges, but they're not standing still.
Yeah.
They're taking a bold gamble by shifting their focus. But let's talk about the elephant in the room.
Okay.
That 5.9% dividend yield. It's incredibly tempting, but is it too good to be true?
Yeah.
Can they really afford to keep paying out that much
Right.
while going through this major transition?
Well, UPS is publicly committed to its dividend, and they're even planning a slight increase in 2025. Their target is a payout ratio of 50%, meaning they pay out 50% of their earnings as dividends.
But currently they're exceeding that ratio, right?
Yeah.
That sounds a bit risky.
It does raise a red flag.
Okay.
However, the CEO explained that their pension expenses are distorting the picture, making the payout ratio appear riskier than it actually is.
So are you saying there's no need to worry about the dividend?
Not exactly. While the CEO's explanation is reassuring, it's crucial to understand what a payout ratio is and why exceeding it can be a concern.
Okay.
Simply put, it's the percentage of profits a company distributes to shareholders as dividends. If a company consistently pays out more than it earns, it can put a strain on its finances and limit its ability to invest in growth.
Okay, that makes sense.
Yeah.
So even though UPS is saying the dividend is safe, we still need to watch closely and see if their earnings improve to support it?
Absolutely. And that brings us back to the bigger picture.
Okay.
The Motley Fool is cautiously optimistic about UPS, but they acknowledge the uncertainty. The stock is currently trading at a price-to-earnings ratio, or PE ratio, of 16.4, which is considered relatively cheap. But remember, a low PE ratio doesn't automatically make a stock a bargain.
Right.
It could simply reflect the market's perception of the company's risks and future prospects.
So we've got this intriguing situation.
Yeah.
A company with a storied history facing significant challenges, but making bold moves to reinvent itself. They're offering a juicy dividend,
Yeah.
but there are questions about its sustainability.
Uh-huh.
And all of this is playing out against a backdrop of economic uncertainty.
Right.
What's a savvy investor to do?
That's what we'll explore next. We need to dig deeper into those two key growth areas,
Okay.
SMBs and healthcare logistics, to assess whether they hold the key to UPS's turnaround.
All right. Sounds good.
Yeah.
All right. We've established that UPS is pinning its hopes on these two key areas for growth.
Yeah.
Small and medium businesses, or SMBs and healthcare logistics.
Right.
So let's put those under the microscope and see if we can find some clues about whether their gamble will pay off.
Yeah. The SMB market is a smart target for UPS.
Okay.
It's a massive and growing segment, and as we mentioned earlier, SMBs tend to be less price sensitive than larger companies, which means higher potential margins for UPS.
But even if SMBs are willing to pay more, can UPS really attract enough of them to replace the lost business from Amazon?
That's where their Digital Access Program, or DAP, comes in.
Okay.
It's not just about offering shipping services. It's about providing a comprehensive suite of tools and solutions that help SMBs streamline their entire logistics operations.
So they're not just a shipping company anymore. They're becoming like a tech-enabled logistics partner.
Precisely.
Yeah.
And the early results are impressive.
Okay.
DAP has already generated billions in revenue, and it's growing rapidly. But the key question is, can they sustain that momentum?
What should we be watching for to gauge the success of DAP then?
Keep an eye on the number of SMBs using the platform.
Okay.
Is it growing steadily? Are they attracting new customers? Also look for signs that they're expanding the services offered through DAP.
Okay.
Are they adding new features, integrations, or partnerships that make it even more valuable to SMBs?
So essentially, we're looking for evidence that DAP is becoming this like sticky platform
Yeah.
that SMBs rely on and can't live without. Makes sense. Now let's turn our attention to healthcare logistics.
Okay.
That seems like a completely different ballgame.
Yeah.
How is UPS positioning itself to win in this space?
They're making strategic moves to build a strong presence in this rapidly growing market. Their recent acquisition of a European company specializing in cold chain shipments is a prime example. This gives them the expertise and infrastructure to handle the delicate transport of temperature-sensitive pharmaceuticals and medical supplies.
I see. So they're not just throwing money at the problem. They're acquiring the specialized knowledge and capabilities they need to succeed in this niche market.
Exactly. And it's not just acquisitions. They're also investing heavily in building specialized facilities designed to handle the unique requirements of healthcare logistics.
Okay.
These facilities offer features like temperature-controlled storage, real-time tracking, and expedited delivery options.
It sounds like they're pulling out all the stops to become a major player in healthcare logistics.
Yeah.
But are they on track to meet their ambitious revenue goals?
Remember, they're projecting a doubling of revenue in this sector by 2026.
Wow, that's a bold target.
It is.
Yeah.
To get a sense of their progress, pay close attention to their quarterly earnings reports. Are they hitting their revenue targets? Are they signing new partnerships with major healthcare providers? Are they expanding their network of healthcare-focused facilities?
Okay.
These are all signs that they're gaining traction.
All right, so we've got a handle on the growth areas.
Yeah.
Now let's circle back to the elephant in the room.
Okay.
That 5.9% dividend yield.
Right.
We've talked about the payout ratio and the CEO's explanation about pension expenses. But I'm still a bit wary. Is there anything else we should be looking at to assess the sustainability of the dividend?
Absolutely. While the payout ratio is a key metric, it's not the only factor to consider.
Okay.
We also need to look at the company's overall financial health. Are they generating enough cash flow to cover their dividend payments? Are they taking on excessive debt?
Right.
Are their earnings growing consistently? These are all important indicators of whether a company can afford to maintain its dividend over the long term.
So even if the payout ratio looks manageable on paper, we need to make sure the underlying fundamentals are solid. It's like checking the foundation of a house before you buy it, right?
Precisely. And speaking of foundations,
Yeah.
remember that UPS's entire strategy hinges on their ability to successfully transition away from low-margin business like Amazon and towards higher-margin sectors like SMBs and healthcare.
Okay.
If they can't pull that off, the dividend could be at risk regardless of the payout ratio.
That's a sobering thought.
Yeah.
So ultimately, the dividend is only as safe as the company's ability to execute its turnaround strategy. But how can we assess their progress? What signals should we be watching for?
That's a great question, and it leads us to the heart of our investigation.
Okay.
We need to look for tangible evidence that their strategic shift is working.
We've talked about UPS's challenges, their ambitious strategy, that tempting dividend.
Yeah.
But it all comes down to execution. Can they actually pull this turnaround off?
Right.
What should we be watching for to gauge their progress?
Well, the key really lies in those two growth areas we've been discussing. First, let's revisit their focus on small and medium businesses.
Right.
If their strategy is working, we should see consistent growth in the number of SMBs using their digital access program.
Okay.
Think of it as a popularity contest. The more businesses flock to DIP, the stronger the signal that UPS is providing real value.
So we're looking for evidence that DIP is becoming a must-have for SMBs, not just a nice-to-have.
Exactly.
But what about the numbers? What kind of financial indicators should we be tracking?
Keep a close eye on the revenue generated by DIP.
Okay.
Is it growing at a healthy pace? Are they expanding the range of services offered through the platform? And most importantly, are those services translating into higher profit margins for UPS?
Right, because remember, their whole goal is to shift away from low-margin business and focus on profitability.
Exactly.
Okay, so DAP needs to be both popular and profitable for UPS's strategy to work.
Right.
Now let's shift gears to healthcare logistics. What signs should we be looking for to determine if their investments in this sector are paying off?
Watch for announcements about new partnerships with major healthcare providers or pharmaceutical companies. Those are strong indicators that UPS is gaining a foothold in this specialized market. Also look for news about facility expansions or acquisitions that enhance their capabilities in areas like cold chain logistics or the handling of sensitive medical equipment.
So essentially, we're looking for evidence that they're not just talking the talk, but also walking the walk.
Exactly. And ultimately, the proof is in the pudding.
Yeah.
Are they hitting their ambitious revenue targets for this sector? Remember, they're aiming to double their healthcare revenue by 2026.
Right. And if they fall short, it could raise doubts about their ability to execute their overall strategy.
Yeah, it could.
It's like we're piecing together a puzzle looking for clues to see if the picture they're painting is coming into focus. But even if they make progress in SMBs and healthcare, there's still the issue of that massive hole left by Amazon.
Right. How can we tell if losing their biggest customer is going to sink them or make them stronger in the long run?
That's where overall shipping volumes come into play.
Okay.
If losing Amazon leads to a significant and sustained drop in volume, that isn't offset by growth in other areas, it could spell trouble.
Right.
On the other hand, if they manage to replace that lost volume with higher margin business from SMBs and healthcare, it could validate their strategy and ultimately lead to a stronger, more profitable company.
So it's a delicate balancing act they need to make up for the lost volume.
Yeah.
But they also need to make sure that new business is coming in at higher margins.
Right.
It's not just about filling the truck. It's about filling it with the right kind of cargo.
Precisely. And that's where operating margin becomes a crucial metric to watch.
Okay.
Remember, it measures how much profit a company makes for every dollar of revenue. If UPS's operating margin starts to expand, even if revenue growth is slow initially, it would suggest that their shift towards higher margin business is working. It's a classic case of short-term pain for potential long-term gain. They might take a hit on revenue in the short term, but if they can improve their profitability, it could set them up for a much brighter future.
Exactly. And that's why it's so important to look beyond the headline numbers and really understand the nuances of a company's situation.
Yeah.
The Motley Fool's analysis provides valuable insights, but ultimately it's up to each individual investor to weigh the risks and rewards and make their own decisions.
And that's what this deep dive has been all about.
Right.
We've examined the evidence, explored the possibilities, and hopefully equipped you with the knowledge and the tools to continue your own investigation into UPS.
Yeah.
Remember, investing is a journey, not a destination. The more you learn, the more informed your decisions will be.
Absolutely. So as you follow UPS's progress, keep those key signals in mind.
Okay.
Watch for growth in their digital access program, their performance in the healthcare sector, their overall shipping volumes, and most importantly, their operating margins.
These metrics will tell you a lot more than just the stock price or the dividend yield.
They'll give you a deeper understanding of whether UPS is truly on track to turn things around and deliver for its investors. We hope this deep dive has been helpful. Always remember to do your own research and make informed investment decisions that align with your individual goals and risk tolerance. Until next time, happy investing.